The uncomfortable truth: you've spent weeks, maybe months, building your trading system. You've backtested it. The numbers look great. Win rate is solid. Risk-reward ratio makes sense. On paper, it works. Then you go live, and everything falls apart. Not because the system was wrong, but because you couldn't follow it. This is the part nobody talks about when they sell you trading courses or strategy guides. They show you the setup, the entry, the exit. They don't show you what happens inside your head at 2 p.m. when the trade is down 3% and your finger is hovering over the close button. The system was never the problem. You were. How fear hijacks your trades. Fear in trading shows up in two brutal ways, and most traders only recognize one of them. The first is obvious: fear of losing money. Your trade is in the red. The candles are falling. Your chest tightens. Your system says hold, your stop loss hasn't been hit yet. But the pain of watching that number go down feels unbearable. So you close early. You take a smaller loss than your plan allowed, telling yourself you were being smart. Then the market reverses. The trade hits your original target. You would have made money, but instead you have a small loss and a lot of regret. The second form of fear is less talked about: fear of missing out. The market is running hard. A stock is up 8% and still going. You had no plan for this trade. Your system gave no signal. But everyone seems to be making money, and you're sitting on the sidelines, so you jump in at the top. Minutes later, the move reverses. You're stuck holding a position with no clear stop, no target, and no plan. You either panic, sell at a loss, or hold in hope. Both of these decisions came from fear. Neither came from your strategy. How greed destroys what fear didn't. If fear makes you act when you shouldn't, greed makes you hold when you should act. Your trade is up nicely. Your system says the target has been reached. Time to book profits. But the trade looks strong. Maybe it goes higher. You think, let it run a little more. So you move the target, then move it again. You're no longer following a plan. You're chasing a feeling. And feelings in markets are almost always wrong at the extremes. The trade reverses, gives back most of your profit, and you exit frustrated, even though you were right about the direction. Greed also shows up in position sizing. You've had a few good weeks. Confidence is high. Your system says risk 1% per trade. But you feel sure about this one, really sure, so you put in 5%. The trade fails. One loss wipes out 5 previous wins, not because your analysis was wrong, because greed bypassed your risk management. Why your brain is wired against you here is the brutal biological reality. Your brain was not designed for trading. The human brain evolved to respond to threats immediately and to chase rewards aggressively. In the wild, hesitation could mean death. Seeing opportunity and not acting felt dangerous. In trading, this wiring is poison. Markets require you to sit still when every instinct says move. They require you to cut losses fast when your brain screams, who'll come back? They require you to take profits at a defined level when greed says, wait for more. Every natural human response is roughly the opposite of what disciplined trading demands. This is why intelligent, logical people blow up their accounts. It's not an IQ problem. It's a nervous system problem. When real money is on the line, the emotional brain takes over from the rational brain, and it makes decisions based on survival instincts, not probability and risk management. The gap between knowing and doing: every trader knows they should follow their system. Everyone knows you shouldn't revenge trade, shouldn't move stop losses, shouldn't enter without a setup. But knowing and doing are two completely different things under emotional pressure. Think about it this way: you know you shouldn't eat junk food at midnight. You know it. But at midnight, when stress is high and willpower is low, that knowledge means very little. The feeling is louder than the knowledge. Trading is exactly the same, except the stakes are your actual money. The gap between your system on paper and your system in execution is filled entirely by psychology. Traders who close that gap are the ones who survive long-term. Those who ignore it keep wondering why a good system keeps losing money. What actually fixes it? The solution is not to eliminate emotions. That's impossible. The solution is to build a process so clear and mechanical that emotions have less room to operate. This means writing your rules down before the trade, not during. It means defining your stop and target before you enter, not while you're in the position. It means reviewing your trades in a journal so you can see patterns in your emotional behavior, not just your technical decisions. Professional traders are not emotionless robots. They feel fear. They feel greed. The difference is they have built systems and habits that make acting on those emotions harder, not easier. Your strategy is probably fine. The question is whether you have built the psychological infrastructure to actually follow it when the market is moving fast and money is on the line. That infrastructure, not a better indicator or a new setup, is what separates consistently profitable traders from everyone else. Loss aversion. Why losing hurts more than winning feels good. The setup nobody warns you about. Imagine two scenarios. In the first, you make a 10 zalauren on a trade. Clean exit, perfect setup, everything went according to plan. You feel good, satisfied. Maybe you tell someone about it. In the second scenario, you lose a $10 on a trade. Same amount, opposite direction. How do you feel now? If you're being honest, the loss feels significantly worse than the win felt good. Not equal. Not even close. The loss lingers. It follows you into the evening. You replay it. You second-guess every decision. The win. You've mostly forgotten it by dinner. This is not weakness. This is not inexperience. This is your brain working exactly as it was designed, and it is costing you money every single day you sit in front of a chart. The science behind the pain. In the 1970s, psychologists Daniel Kahneman and Amos Tversky ran a series of experiments that changed how we understand human decision-making. What they discovered became known as prospect theory, and it revealed something deeply uncomfortable about how humans process gains and losses. Their finding was simple but devastating. Losses feel roughly twice as painful as equivalent gains feel pleasurable. Losing 5,000 hurts approximately as much as gaining when 10,000 feels good. The pain is not proportional to the money. It is disproportionately heavy on the loss side. This asymmetry is hardwired. It does not matter how experienced you are, how logical you think you are, or how many books you have read. The emotional weight of a loss is fundamentally heavier than the emotional reward of a gain of the same size. For traders, this single psychological fact explains more account blowups than any bad strategy ever could. What loss aversion looks like in a live trade. You enter a trade. It moves against you. Your stop loss is sitting there, placed before entry, calculated correctly, positioned at a technically valid level. The price approaches your stop, and here is where loss aversion takes over. Your brain does not see a stop loss being hit as a neutral, planned event. It registers it as a real, immediate, painful loss. The instinct fires, do something to avoid this pain. So you move the stop lower. Just a little more room, you tell yourself. It'll bounce from here. The stop moves from a 500 below entry to L1000 below, then a 1500. Each time the price drops, the story changes. It's oversold. The sector is still strong. This is just noise. What you are actually doing is negotiating with the market to avoid feeling pain. And the market does not negotiate. The position continues lower. What was a manageable 500 loss is now a 33,000 loss. Then we're 5,000. At some point, either the account margin forces you out, or the pain becomes so unbearable that you finally exit at the absolute worst possible moment. Every step of this process was driven not by analysis, but by the desperate need to avoid the psychological pain of accepting a loss. The "it'll come back" loss aversion comes with a built-in story that traders tell themselves to justify holding losing positions. The story always sounds reasonable. It always feels logical in the moment. And it is almost always wrong. It'll come back. Sometimes it does. And that is the most dangerous outcome possible, because it teaches your brain that holding through losses works. It reinforces the worst habit a trader can have. The 10 times it doesn't come back, and the loss compounds into something catastrophic, never seem to teach the same lesson as the one time it recovered. This is called intermittent reinforcement, and it is the same psychological mechanism that makes gambling addictive. Occasional rewards for bad behavior are more psychologically powerful than consistent punishment. Your brain remembers the recovery and forgets the disasters, so the losing trade that eventually broke even. That memory is destroying your future trades. The flip side, cutting winners too early. Loss aversion does not only cause you to hold losers too long, it also causes you to exit winners too soon. When a trade is profitable, loss aversion immediately starts whispering, "What if it reverses? You'll lose these gains. Take the money now. Lock it in." The fear of losing an unrealized profit triggers the same pain response as the fear of an actual loss. So traders cut winners at 40% of their target because the thought of giving back open profit feels unbearable. The result is a devastating combination. Losses are held far too long, and winners are cut far too short. Even if your system has a 60% win rate, this behavior can make it unprofitable in practice. You lose big and win small, the exact opposite of what sound risk management requires. Why accepting loss is a skill, not a feeling. Most traders approach loss acceptance as an emotional problem, something to push through, to be tougher about, to not let bother them. That framing is wrong, and it sets people up to fail. Accepting losses is not about feeling nothing. It is about building a framework where the decision to exit a losing trade is made before the trade begins, not during it, when emotions are at maximum intensity. When you are sitting in a losing position, watching real money disappear in real time, you are in the worst possible mental state to make a rational decision. Your loss aversion is firing at full strength. The pain is real. The pressure is enormous. This is precisely the wrong moment to decide where your stop-loss should be. Professional traders make that decision when the market is closed, the screen is calm, and no money is at risk. They define the maximum acceptable loss before entry. They treat that number not as a suggestion but as a contract with themselves. And when price hits it, the position closes, automatically if possible, manually if necessary, regardless of how it feels in that moment. The stop-loss is not where you predict the trade will go wrong. It is where you have agreed in advance that you were wrong. That distinction changes everything. The only way out, loss aversion will never disappear. You cannot train it out of your nervous system, but you can build a trading process that removes the opportunity for it to make decisions. Pre-defined stops, fixed position sizes, automated exits where possible. A trade journal that forces you to confront how often it'll come back it didn't come back. These are not just technical tools. They are psychological defenses against a bias that is older than any financial market. The traders who survive long-term are not the ones who feel no pain when they lose. They are the ones who built a system that executes correctly even when the pain is loudest. Because in trading, the ability to take a small loss cleanly and move on is not just a good habit. It is the single most important skill you will ever develop. Overconfidence. Why winning streaks are more dangerous than losing streaks when success becomes the trap. 3 winning trades in a row. Maybe 4. Each one clean, profitable, exactly as planned. The account is growing. The setups are working. Everything feels clear. And right there, in that feeling of clarity, is where most traders begin to fall apart. Overconfidence does not arrive looking like arrogance. It arrives looking like experience. It feels like pattern recognition. It whispers, "You understand this market now. You've figured something out." That whisper is one of the most expensive sounds in trading. What actually happens in your brain after a winning streak? Your brain releases dopamine, the same chemical triggered by gambling wins, social approval, and sugar. It feels genuinely good, and dopamine does something specific. It increases your appetite for risk while simultaneously lowering your perception of danger. You do not feel reckless. You feel confident. Those are not the same thing, but in the moment they are completely indistinguishable. This is why overconfident traders do not think they are making emotional decisions. They believe they have earned the right to take bigger positions, bend the rules slightly, skip confirmations. Every deviation from the system feels justified by recent success, not driven by a chemical reaction in the brain. How the rules break down, it never happens all at once. Overconfidence dismantles discipline gradually, in small steps that each feel reasonable. First, position size increases. Your system says risk 1% per trade, but you feel good about this setup, really good. So you go in at 2%, then 3%, it still wins. Next trade, 4% feels justified. Then entry rules loosen. Normally you wait for a specific confirmation before entering. This time the setup looks right, even without it. You enter early. It works. Now the confirmation feels optional. Then stop losses get moved. Since recent trades have been winners, the thought of getting stopped out on a small move feels unnecessary. So the stop goes wider. Give it room. You tell yourself. Each of these changes feels like a confident, experienced decision. Collectively, they have turned a disciplined system into a series of high-risk gambles. One bad trade, and at these position sizes, one bad trade is all it takes, wipes out every gain from the entire streak. Sometimes more. The core illusion skill vs luck here is the brutal truth about winning streaks. You cannot tell in real time how much of it was skill and how much was luck. Markets go through phases. Sometimes a particular style of trading works beautifully because conditions favor it, not because the trader has mastered anything. Momentum strategies crush it in trending markets. Mean reversion strategies thrive in ranging markets. A trader can run a 5-trade winning streak purely because the market was temporarily aligned with their approach. When conditions shift, the edge disappears. But the overconfidence built during the streak remains, and now it is making oversized bets in a market environment that no longer supports them. Professional traders evaluate their process, not their recent results. A well-executed trade that loses money is considered a success. A poorly executed trade that happens to profit is considered a failure. This distinction protects them from the illusion that short-term wins equal mastery. The fixed rules are for good days, not just bad ones. Most traders think of rules as protection against their worst moments, the revenge trades, the panic exits, the emotional spirals. That is true, but rules are equally important as protection against your best moments. The version of you riding a winning streak is just as dangerous as the version of you chasing losses. Both have abandoned objective judgment. Both are making decisions based on emotion rather than process. The fix is mechanical consistency, following the exact same rules whether you are up 5 trades or down 5. Same position size, same entry criteria, same stop discipline. Every single time. Not because the rules are perfect, but because consistency is the only way to know whether your system actually has an edge, and the only way to protect that edge when your brain is convinced it no longer needs protecting. The market has a long history of humbling traders right at the peak of their confidence. The streak ends. It always ends. The only question is how much damage overconfidence does when it does. The moment it begins, you had a clean setup. Everything lined up, the structure, the confirmation, the risk-reward. You entered with confidence. Then, the market moved against you. Hard. Maybe it stopped you out cleanly. Maybe it reversed right after your exit, which somehow feels even worse. Either way, the result is the same. Money is gone, and something inside you refuses to accept it. That refusal is where revenge trading is born. It does not feel irrational in the moment. It feels like determination, like focus, like getting back to work. Your internal voice sounds reasonable. I know this market. I just had bad luck. Let me get back what I lost. That voice is not your trading instinct. It is your wounded ego. And it is about to make everything significantly worse. What revenge trading actually is? Revenge trading is any trade entered primarily to recover a recent loss, rather than because a genuine system-based setup exists. The motivation is not opportunity. It is pain relief. When you lose money, your brain registers it as a threat, not just financially, but psychologically. Your sense of competence is attacked. Your self-image as a capable trader takes a hit. The discomfort is real and immediate, and the brain desperately wants to resolve it as fast as possible. Entering the market feels like resolution. It feels like action, control, and the possibility of erasing the pain. But the trade is not based on logic. It is based on the need to feel better, and markets do not care about your feelings. The psychological spiral. Revenge trading rarely happens just once. It operates as a spiral, and each rotation makes the next one worse. It starts with one bad trade. The loss triggers emotional distress. You enter a revenge trade without a proper setup. That trade also loses, because it was never based on sound analysis to begin with. Now the loss is larger, the distress is greater, and the urge to recover is even stronger. So you enter again. Bigger this time, because you need to make back more money in less time. This trade loses too. Within an hour, what started as a manageable single loss has become a catastrophic session. The account that took weeks to build has been damaged in an afternoon, not by one bad setup, but by the emotional chain reaction that followed it. This is not a rare scenario. It is the single most common way that traders with genuine skill and solid systems blow up their accounts. Not gradually, through a series of small mistakes, but in one emotional afternoon of revenge trading that compounds faster than any rational mind would allow. Why position size explodes? One of the most destructive features of revenge trading is what it does to risk management. Under normal circumstances, a disciplined trader risks a fixed percentage per trade, typically 1% to 2% of account capital. This keeps any single loss manageable and preserves the account for future opportunities. But in revenge trading mode, that framework collapses completely. If you lost by 5,000 on a 1% risk trade, recovering it with another 1% trade means sitting through multiple wins just to get back to zero. That feels too slow. The emotional brain wants immediate resolution. So position size jumps to 5% to 10%, sometimes more. Now a second loss does not cost 5,000. It cost on 25,000. The math that protected you has been abandoned entirely, and the account is now exposed to damage it was never designed to absorb. This is why revenge traders do not just lose what they lost in the original trade. They lose multiples of it because the emotional need for speed destroys the risk management that made the system viable. The market does not owe you a recovery. This is the hardest truth to internalize and possibly the most important one in all of trading psychology. The market has no memory of your last trade. It does not know you are down. It does not care that you had a perfect setup that somehow failed. It owes you absolutely nothing, not a recovery, not a fair shake, not a chance to break even. Every moment in the market is completely independent of what happened before it. Your loss from the previous trade is entirely irrelevant to whether the next trade will win or lose. The market does not adjust itself based on your emotional state or your account balance. When you enter a revenge trade, you are operating under the subconscious belief that the market somehow needs to give back what it took. That belief has no basis in reality. It is pure emotion dressed up as logic, and trading on it means entering every revenge position already at a psychological disadvantage. What a professional does, after a loss, the difference between a struggling trader and a consistently profitable one is visible most clearly in what they do in the 5 minutes after a bad trade. The struggling trader immediately looks for the next entry. The screen stays open. The position size goes up. The rules quietly get set aside. The professional closes the platform, steps away, physically removes themselves from the ability to trade impulsively. They understand that the mental state immediately following a loss is one of the worst possible states for decision making, and that protecting the account sometimes means protecting it from themselves. This is not weakness. It is the highest form of trading discipline. A pre-defined daily loss limit is one of the most effective structural tools against revenge trading. When losses for the day hit a set number, say 2% of account capital, trading stops. Completely. No exceptions, no override, no, just one more. The rule exists precisely because it needs to function when emotions are at their peak and the rational mind is at its weakest. The real recovery here is what nobody tells you about recovering from a bad trading day. The fastest path back is not through more trades. It is through stopping. A 10% account loss requires an 1% gain just to break even. A 25% loss requires a 33% gain. A 50% loss requires a full 100% gain to recover. The math of drawdown is brutally asymmetric. The deeper the hole, the harder the climb out. Every revenge trade that loses makes the recovery longer, harder, and psychologically heavier. Every trade you do not take after a bad loss is capital preserved for a day when your mind is clear, your setup is genuine, and your process is intact. Walking away is not giving up. It is the trade that saves your account, the one where you chose not to let one bad hour turn into one lost month. The market will be there tomorrow. With a clear head, a full account, and a real setup, that is when you come back. The wrong goal. Almost every trader, at some point, sets the same internal goal. I need to get my emotions under control. It sounds mature. It sounds disciplined. It is also completely the wrong objective, and chasing it leads to frustration, self-blame, and eventually quitting. Emotions cannot be controlled. Fear, greed, overconfidence, revenge impulses. These are not character flaws you can fix with enough willpower or positive thinking. They are hardwired neurological responses built over hundreds of thousands of years of human evolution. No amount of meditation, discipline, or self-improvement removes them entirely. The traders who last are not emotionless. They simply stopped trying to win a fight that cannot be won and started building something smarter instead. Process over. Feeling the shift that separates struggling traders from consistent ones is deceptively simple. Stop making decisions during the trade and start making them before it. Every decision made while money is on the line is made under emotional pressure. Entry, stop, loss, target, position size. If any of these are being calculated while a position is open, emotions are already involved. The fear of loss, the pull of greed, the sting of a recent trade, All of it floods into the decision at exactly the wrong moment. A written process eliminates this. Entry criteria defined in advance. Stop loss calculated before execution. Target set before the position opens. Position size determined by a fixed formula, not by how confident you feel today. When the process is fully defined before the trade begins, the emotional brain has nothing left to decide. Its input arrives too late, the decisions are already made. The trade journal boring, essential, transformative. No single habit builds consistency faster than keeping a detailed trade journal. And almost no habit is more consistently ignored. A trade journal is not a record of wins and losses. It is a record of your decision-making process, what you saw, what you thought, what you felt, what you did, and what actually happened. Over weeks and months, patterns emerge that are completely invisible without written documentation. You begin to see that your worst losses cluster on Monday mornings, or after consecutive winning days, or whenever you deviate from a specific entry rule. You see that your best trades share three common characteristics. You see the exact moment in your journal entries where emotion entered the decision, the language changes, the reasoning gets vague, the rules get bent. This awareness does not eliminate emotional trading overnight, but it makes the patterns visible, and visible patterns can be addressed with structural changes. Without the journal, you are flying blind, repeating the same emotional mistakes with no data to show you that you are doing it. Rules are the architecture of consistency. A process without written rules is just a preference, and preferences bend under pressure. Effective trading rules are specific, unconditional, and written down before the trading session begins. Not, I will try to risk about 1% per trade, but maximum risk per trade is 1% of account capital, no exceptions. Not, I will avoid trading when I am emotional, but if I hit a 2% daily drawdown, the platform closes and trading stops until tomorrow. The specificity matters enormously. Vague rules create negotiating room, and when emotions are running high, your brain will exploit every inch of that room. Precise rules leave no room for negotiation because there is nothing to negotiate. This is not rigidity, it is architecture. A building is not inflexible because it has walls, it is functional because of them. Trading rules are the walls that keep the structure standing when external pressure builds. Consistency is measured in process, not profit. The deepest mindset shift required for long-term trading success is learning to evaluate yourself on process quality rather than outcome quality. A trade that followed every rule perfectly and still lost money is a successful trade. The process worked. The outcome was unfavorable, but outcomes in any single trade are partly determined by randomness, and randomness cannot be controlled. A trade that broke two rules and happened to be profitable is a failed trade. The process broke down. The profit was real, but it came from luck, not skill, and luck does not repeat consistently enough to build a career on. When you measure consistency by process rather than profit, losing trades lose their emotional charge. A loss that followed the rules is simply data, evidence that the market did not move as the analysis suggested, nothing more. It does not reflect on your intelligence, your skill, or your future as a trader. This reframing is not a psychological trick. It is the accurate way to think about probabilistic outcomes. No system wins every trade. What a system can do is produce positive expectancy over hundreds of trades, but only if it is followed consistently enough for the edge to express itself. Mastery in trading is not the absence of fear or greed. It is the construction of a process so clear, so specific, and so consistently followed that fear and greed simply arrive too late to change anything. The entry has already been defined. The stop is already placed. The size is already fixed. By the time emotion shows up with an opinion, the work is done. That is not emotional control. That is something better, a system where emotions have no meaningful role left to play. Build that, and consistency takes care of everything else.